The U.S. and China may be nearing a trade truce, but Philippine businesses remain wary of lasting impacts. Jin Kim has the details.
The U.S. and China appear to have reached a breakthrough after talks on a trade truce framework in London. But despite the optimism, Philippine business leaders remain cautious as they continue to seek ways to shield the country from the lingering effects of the trade war.
Every 1% of tariff imposed by a country hurt the country. That's on top of non-tariff measures being imposed by other countries.
An economic conflict between the world's two largest economies would have a ripple effect. Fortunately, the Philippines found itself in a relatively favorable position. The direct impact of the reciprocal tariffs on the economy is being mitigated by the following.
During a recent business forum, officials from the Agriculture and Trade Departments underscored the need to expand the country's export footprint.
Expanding our trade partnerships, deepening regional integration through ASEAN or RCEP, and potentially through bilateral deals that open up more equitable access for our agri-fishery products. The DA has been working hand in hand with the Department of Trade and Industry to open more markets abroad to diversify our markets. We must also diversify our sources of critical inputs like feeds, fertilizer, and machinery.
We want a virtuous cycle of sustained economic growth. It's essential not only to diversify our export base, but also to build resilience against external shocks and market volatility.
Meanwhile, industries with minimal exposure to U.S. tariffs, such as semiconductors and mining, are relatively unfazed.
The semiconductor and electronics industry is probably in a better position. Most feel badly about saying this, but for the semiconductors, the integrated circuits that we export, there's no tariff, right? Zero tariff.
The mining industry, in my view, in our view in the industry, would have minimal, if not hardly recognizable effect from the U.S.-China tariff trade war. Because one, we do not actually export to the United States. We do export a lot to China. And that is where there will be some, if assuming that China increases the tariff against us, then that will be a problem. But thus far, it has not, and I don't think it will.
But Toledo warned that a slowdown in the Chinese economy could still ripple into the Philippines.
And if the Chinese economy slows down, then the demand for minerals coming from the Philippines will be affected. And perhaps also those companies that are dependent, mining companies, for example, that are dependent on equipment that are purchased from China, for example, or from other countries. If the walls or the tariff walls are put up, then that will be difficult for them.
Former Finance Chief Gary Teves stressed that beyond export diversification, the country must improve ease of doing business and ensure sound fiscal management. Jin Kim, Billionaire News Channel.